If you trade spreads on Robinhood, do not hold them into expiration. I repeat, do not hold them into expiration. Because if you do, you just might get something that looks like this. And yes, spreads are supposed to be defined risk trades. And while in most cases they do work out the way they're supposed to, but I'm here to tell you that people do end up owing some serious cash just because they held a spread into expiration on Robinhood. Hey, what's good? It's your boy Matthew Michael, and in today's video, I'm going to talk about Robinhood spreads on expiration. What could happen if you hold into expiration? Why you should close out before expiration? And last but certainly not least, I will actually get in Robinhood and show you how to close an actual spread. So if you're new here, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post 2 new videos every week, and I would absolutely love to have you as part of the family. Also, please be sure to smash the like button because I work hard on these videos and it's really the only thing I ask for in return. And one last thing before we get into the video, I'm just going to take my Instagram and I'm going to leave it right here. Do with it as you will. And without further ado, let's get into the video. Alright, so like I said earlier, we're going to achieve 3 main things in this video. We're going to talk about what could happen if you hold a spread into expiration. We're going to talk about why you should close a spread before expiration. And last, but certainly not least, we're going to hop into the handy dandy Robinhood and we're going to close a spread together. But of course, since we'll be talking about credit spreads and debit spreads, let's start off by covering the difference. A credit spread is a trade in which you sell the strike closer to the money and buy a strike further out to manage your risk. The overall transaction results in a net credit, which means that you receive money to open the trade. And just so that everyone's on the same page, let's take a quick moment to hop into the handy dandy Robinhood and take a look at an example. All right, and here we are in the handy dandy Robinhood, and we're going to take a look at how to set up a credit spread. And as usual, we're going to take a look at Apple because I love using Apple as an example. So we're going to hit trade options. And we're just going to pick a random date, doesn't matter. The more time that you get on your credit spread, the more credit you'll receive, but also the longer it'll take to get that credit. But just for an example, I'm just going to pick a random date. All right, and we're going to do a put credit spread, meaning that we hope the price of the stock will either stay the same or go up. So I'm going to hit select, and by hitting select in the corner, this allows you to pick 2 different contracts on the same transaction. And if you don't have that selected in the corner, in order to get that, you actually have to go to your settings on Robinhood and apply for higher level options trading. And then once you do that, you should be able to get that. But going on, let me show you how to set up this trade. And since we're looking at puts, everything above this share price of 114.53 is going to be in the money. And just so you see, let's look at everything above. Notice the price of the contracts getting higher. That's because they're in the money. Everything below is considered out of the money, and the further down you go, the further out of the money you are. But going back to the money, so with the credit spread, you want to make sure you sell the one closer to the money, and it doesn't have to be in the money, it could be out of the money. And for this example, we're going to get one out of the money. Okay, grab this 110 put, and this is an important part to make sure it's a credit spread. You want to make sure that you buy one further out of the money. So I'm going to make sure I'm on this buy tab up here. And then I'm going to scroll down even more to make sure I'm further out of the money than I was when I sold it. So I sold that 110 and I'm just going to buy one further out. I'm going to buy this 106. Okay. And notice when I set it up like that, it says total credit. When you see that total credit, you know you've created a credit spread. All right. So now that you know what a credit spread is, a debit spread is going to be the opposite. So this time, instead of selling the contract closer to the money, you're going to buy the contract closer to the money and sell the contract further out. This overall transaction results in a net debit, which means that you have to pay to open the spread. And just to make sure that we're still on the same page, let's hop into the handy dandy Robinhood yet again and take a look at how to set up a debit spread. Here we are yet again in the handy dandy Robinhood, looking at Apple, of course, my favorite example. And now we're going to take a look at how to set up a debit spread. So yeah, we're going to go back to trade options. Of course, you're going to pick your date. After you have your date picked up, it's important to know that unlike the credit spread, if you get a put credit spread, you want the put credit spread to go up, but if you get a put debit spread, you want the price to go down. So I'm actually going to get a call debit spread this time because the market goes up more than it goes down. So I'm going to show y'all a call debit spread, but just remember, if you're trying to get a put debit spread, buy the one closer to the money, sell the one further out. So it's the same whether it's a call or put, but yeah, let's set it up. All right, so I'm going to hit this select and we're going to buy this 115. It's just out of the money because everything above was in the money for puts, but now everything below is in the money for calls. So buying this one just out of the money, and then I'm going to make sure I'm on my sell tab, and then I'm going to pick a strike to sell. And then when you do that, you see this says call debit spread instead of credit spread. So this means that instead of receiving the money for opening the trade, you have to pay the money for opening the trade. And that's how you set up a debit spread. Now, both of these spreads are great because theoretically they have defined risk, which means that the most that you can lose is limited. But sadly, that's not always the case. For each spread, there are two theoretical outcomes, and that is they can either expire in the money or they can expire out of the money. And for a credit spread, if it expires in the money, it can result in a loss up to the value of the spread, which is nice to know because that way, if you lose out on the trade, you know that your loss is limited. And if that same credit spread expires out of the money, that's great because you realize full profit no matter what. And again, for a debit spread, it's the opposite. If the debit spread expires in the money, you receive the full profit. And if it expires out of the money, you only lose the money that you paid for the contract. But in reality, this isn't how it always works, and here's why it's better to close out before expiration. To put it simply, you rid yourself of the responsibility of having to deal with 100 shares of the stock if you close out the position before expiration. Because these spreads are made up of two different contracts, they're meant to cancel out the responsibility of the other, leaving you only to pay the difference between the two contracts. But there's no saying that just because a call is in the money, that the person who bought it necessarily wants to exercise it. The problem with spreads are that most contracts cannot be exercised after hours. And while you can't exercise options after hours, the stock price can move dramatically. So let's say you sold a put spread that expires out of the money, which would normally mean that you're going to receive full credit for the spread because it expired worthless. And even though it expired worthless, the person who bought the put still decided to exercise the contract. And they happened to do it right at the end of the day. So Robinhood wasn't able to see it in time, and as soon as the market closes, the stock just dumps $20. That's going to be a huge loss because $20 times 100 shares is $2,000. And that's all on a trade that should have resulted in a profit. The same thing can happen with the debit spread that expires in the money. Because it expires in the money, Robinhood normally exercises the right to buy. But let's say as soon as the market closes, that same stock tanked $20. And the person that you sold the call to manage your risk decided not to exercise the call. Now you're stuck buying 100 shares of that stock for $20 more than it's worth on the stock market. And if you don't have the funds in your account, Robinhood's going to end up selling those shares for whatever they can get them for, as well as selling other shares until they're able to get the money that you owe them now. And if that's still not enough, you'll end up owing them money. And if you don't pay them the money that you owe them, this can impact your credit and this can make life hard for you. But the good thing is that both of these situations can be easily avoided just by closing out of your spreads before expiration. And I know that some of you may want an example of how to close a spread on Robinhood. So you already know what it is. Let's hop into the handy dandy Robinhood and take a look at how to close a spread. All right, now we're going to get in here and look at how to close a spread. Now, I personally have a few spreads open, and I don't have any spreads right now that I'm quite ready to close yet because I'm not profitable on any of them at the moment. And just because I love you guys so much, I'm going to show you how to close a spread using this QQQ credit spread I have right here. So right here, as you can see, I'm down $11 on it. But hey, if it's going to help you learn, I'm going to show you how to close it. All right, so here we are. I'm going to hit trade. I'm going to hit close. And then I have one contract, so I'm going to hit one. And here's the part that can get a little bit tricky. You see the bid price, you see the ask price, and you see it just moving around. So right here, I actually have a put credit spread. Just know that the money for a credit spread, when you have a credit spread, you're going to be buying the contract back in order to get out of the trade. And when you have a debit spread, you're going to be selling it back in order to get out of the trade. So with the credit spread, the closer to the ask that you put the price, the more likely it is that you will get filled on that order. And with the debit spread, the closer to the bid that you put the price, the more likely it is that you'll get filled on that order. Now you see the price over to the right is moving up and down a lot, and that is because the bid and ask prices are fluctuating, and this is the mid price. The mid price works sometimes, but most of the time with the spread, if you try to get filled at the mid price, it's not really going to work out too well for you unless the stock just moves a bunch in your favor. So let me actually show you what that looks like at first, and let's try to get it at the mid price. All right, so as you can see, the order has not been filled that quickly. So I'm actually going to try to replace the order, doing it a little bit closer to the ask price, and we'll see how long it takes to get filled right then. All right, so I'm going to hit replace order, continue, and then I'm going to try 2 cents more. And just like that, doing it for 2 cents more, or it actually came out to be $2 more, I was able to get filled. And I took a loss on that trade just for you, just to show you how to close out a spread. And there you go. So you just learned how to set up a credit spread, how to set up a debit spread, what could happen when you let them expire, and even how to close a spread. If you have any questions or comments, please feel free to leave them down below. If you learned anything new or enjoyed the video, please be sure to smash the like button. And if you're new here and haven't already, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post 2 new videos every week, and I would absolutely love to have you as part of the family. And last but certainly not least, thank you so much for watching, and peace.